Here we are, and we're going to go ahead and we're going to start talking about sales tax payable. This is where we left off at the prior lecture. All of us have experienced a need to pay sales tax at some point in time or another. Colorado State uh, levies sales taxes on pretty much most everything in one shape or form. When we go to purchase whatever it is that we want to purchase, whether it is bottled soda, groceries, dog food, furniture, the retailers collect sales tax from you and I as the customers. And then we take our new property that we have paid that sales tax on and we go home with it. We're said and done as the customers. It doesn't even impact our mind other than we paid more than the sticker price. With the retailer, and in some cases, some service industries, not in the state of Colorado, but in some places it does happen. What happens then is that that retailer takes that amount of money that they collected for sales tax. That money is never logistically or really theirs. They are just the custodian of it, they're a middleman. And then they remit that to the proper governmental authority. So that could be your state, that could be county, that could be a home rule city, that could be a special district. Just really depends upon how the nature of taxes are comprised exactly where you are. We are at a variety of locations here in this class, so we're not going to have everything exactly the same. Also, for example, here in the western slope of Colorado, it in on the Front Range, there's a lot of special districts, but here we have one key one that most people are aware of. In West Glenwood, they built this Meadows shopping center. It has Target and a bunch of outdoor strip malls, Chili's, Lowe's, and there, that is actually a special district area. Anything you purchase there is subject to a special amount of tax above and beyond than if you were to purchase the exact same item on the other side of Glenwood. So, for example, if you go into Target and you buy a small bottle of soda, you're going to pay a little bit more for it if buying it at Target than if you were to buy it at Safeway down on Grand Avenue, because there's a special district tax associated with any tangible personal property that is sold in the Meadows area. That special district does not extend as far as the Safeway on Grand Avenue. So, what I want you to think about as we work through all these, we've all heard of the hubbub about internet and taxes, and like almost like a federal type of a sales tax, so that if you buy something from the internet, you will have to pay all the taxes on it. And what this basically comes down to is sales tax levies on what they call nexus, what you have in common. So, a lot of times when you buy something over the internet, you may only be paying state tax because that store has a store somewhere in the state. If you purchase from something that doesn't have a store anywhere in the state of Colorado or any other type of retail located in the state of Colorado, then you get it without sales tax. The internet has really created a big beehive on sales tax, and I think we're going to see here in the future that a lot of things are going to change in regards to that because e commerce is becoming much more of a driving force than the traditional brick and mortar. We have seen this. We have seen this with the closing of Barnes and Noble stores. We've seen this with the closing of Staples stores. We have seen this with the closing of Borders. A lot of big brick and mortar institutions have felt the sting of e commerce. Uh, Everybody really didn't realize the impact that this would have years ago. They kind of, maybe to date myself a little, they poo pooed it. No, it'll be nothing. It's just a fad. However, that wasn't the case. It's really becoming a normal part of our shopping. I know, as a matter of fact, for myself, one of the first places I went to go look for a new briefcase wasn't at a brick and mortar store, especially because of where we live. We have a limit to the stores we have available. I went to Amazon. That's where I'll buy my new briefcase from, most likely. It won't be from me walking into a luggage store. It won't be from me walking into a mall. Here we have this is your slideshow's illustration in relation to current liabilities. When I get done with this section in regards to sales tax payable, which is really only a couple of slides, I'm going to show you an actual sales tax return just so that you can say you've seen one. Um, and then I will pop up and we will just address a few things in relation to sales tax uh, that come out of the 121 appendix work that you did, just because it phrases it a little bit differently than we phrase it here in this class. So for this illustration, we are going to record an entry for sales tax, and we're going to make an assumption that there was a sale of $3,000 and that there is a 4% sales tax that's in effect. Now, this 4% could be 4% to one taxing jurisdiction or 4% spread out amongst three or four different taxing jurisdictions. We're just looking at the total percentage. So when we collected for the sale, we collected $3,120. Of that, only $3,000 of it is representing for our sales revenue, and $120 of it, 3,000 multiplied by 4%, is representing for sales tax. Now, again, recall that sales tax is actually not revenue for your retailing organization. In reality, all you are is the middleman. You are collecting it for the taxing jurisdiction. So, immediately segregating it as sales tax payable is really the most transparent way to do it. It's also the way most of the computer programs take care of it now with scanners and barcodes and everything. It just automatically routes it to the sales tax payable. Now, for those companies that are not as sophisticated or technologically advanced, sometimes they don't segregate the sales tax and the amount of the sale at the time of the sale. Instead, what they do is they credit all of it into the sales revenues account and then they back it out later. This is sometimes what happens when you go to a craft fair or a flea market or something like that. For those vendors fairs and craft fairs, they are collecting sales tax and remitting them to the appropriate jurisdictions. But however, oftentimes what they're doing it is they're doing it through a back out. So we're going to assume that there's a sales revenue account balance of 150,000. We know this is our sales plus 4% of sales tax. So to prepare the entry to record the amount due to the taxing unit, we have to do a calculation. We take 150,000 and we divide it by 1.04. That is 100% of sales and 4% of sales tax. That tells us that we have sales of $144,230.77, and that when we remove that, we then have sales tax of $5,769.23. It's a little bit more complicated, but if you're in a craft fair or something and you just want to sell things at $10 a piece, this is a little bit easier for you on the front end. And you're not talking about millions of dollars worth of sales. You're talking about something on the smaller side. So we move out of our sales revenue $5,769.23, and we transfer that to sales tax payable for remittance to the appropriate taxing jurisdiction. Now I'm going to really quick flip over to what I have called here the Sales Tax Review 121. Slides. I actually pulled these out of their slides. Just to give you a little bit more information. So your sales taxes will be expressed and stated as a percentage of the sales price. You may have two or three that are in effect, and some things may be taxed only at the state level, but not at the federal, or not at the federal level, my apologies, not at the county level or the city or the home rule town level. As I said, The selling company is the one who is collecting this money from the customer, and they remit that to the state's Department of Revenue. The only other situation that comes in is with home rule cities. Home rule cities are cities that actually collect their own sales tax, and it does not go through the state's Department of Revenue, and they will have their own sales tax return that must be completed and filled out and remitted with the appropriate funds. On March 25th, we have cash register readings for Cooley Grocery Store, and it is showing sales of 10,000 and sales tax of 600. So if you look at that, that is a 6% tax rate. Their cash register is taking care of it, like I said for you at the very beginning. So you should have $10,600 in cash, the 10,000 in actual sales, the 600 in collected sales tax to be remitted to the appropriate taxing authority. So you will recognize cash of 10,600 increase with sales revenue of 10,000 and sales tax payable of 600. Now this is my favorite slide and I just kind of had to share it because you know how I said sometimes companies don't segregate. In 121 it always kind of makes me giggle a little bit because it says sometimes companies are lazy. They sell to the customer and then determine taxes later by calculation. This is the same backing out entry that we used previously where we look at the 10,000, we divide it by 1.06 to tell us how much our sales revenue is. The difference of 9,434 out of 10,000 gives us $566 of sales tax payable. Like I said, I kind of just included it because it's a little bit, it kind of makes me laugh a little bit how this publisher had said sometimes companies are lazy. The other one says sometimes they just don't segregate. In the difference, I did give you some examples of specific situations where we don't see the segregation. And like I said, a lot of times at large craft fairs that you see or vendors types fairs, so they don't segregate it, they back into it and they remit it accordingly. They are required to collect sales tax on sales in the state of Colorado for new tangible personal property. I am going to bring us back to our slides here. And I'm going to make sure we're sitting where we need to be for the next one. Now, as I said, I was actually going to show you a sales tax return. So they actually took on a new form. These used to come in booklets and people would have to fill them out every month. Your sales tax filing is going to be dependent on a variety of factors, but what it comes down to is the amount of sales tax that you have to collect in a given period of time. You can now actually do this online, or you can do it using this exact form. This is a PDF. This is Cardo Sales Tax Return. It does include a variety of the instructions. So as you can see here, you have a state sales tax rate that is 2.9%. Depending upon where you are, you may have some special districts that come into play. uh, or you may have county or city taxes that come into play. And it actually walks you exactly through. This is the DR 100 sales Colorado retail sales tax return. You can find this if you want to Google it and you want to play with it. You are more than welcome to. It's not a requirement of this class, nor is it a requirement that you be able to fill it out. It's just kind of some general additional information for you. Now, the thing to keep in mind is that often the company that is collecting the sales tax actually gets what we call, how do they put it, a service fee. What that is that this will appear, and it is 0.0015% of the total sales tax that was collected. This is what the company basically gets paid for acting as that intermediary and collecting that appropriate sales tax. Now, keep in mind that there are some states that actually do not have a sales tax. And you may have different taxes, as you can see here: county, city, special district, and state percentages relating to different things. So cigarettes maybe is one percentage. However, the state's already built into the price. There may be additional taxes that come into play depending on your county or your city. uh, Food, this could include fast food, or this could include food that is bought through vending machines. Again, vending machines is another area where they have to back it out, right? We put in $1, we get a candy bar. So they're going to have to divide that by the 1.06 to ascertain how much of that is actually sales tax revenue and how much of that should be sales tax, or how much of that is sales revenue and how much of that is sales tax payable. For those of you that are in a regular business program, even those of you that are moving on to the CPA program, you might want to give some thought. Although it is an accounting class, it does not count towards your accounting classes for licensure. Uh, of perhaps taking one of our electives, such as payroll and sales tax class. It is not offered all the time. We are offering it this semester. I'm not sure when we'll offer it next. But if you are intending to actually work as a certified public accountant or bookkeeper, it really does drill a lot of this information in relation to sales tax, such as we're talking about now. And then we're going to talk about income taxes, and then we're going to talk about the employee related taxes. It's the employee related taxes that you're really going to get exposure to in a payroll class. Again, we don't offer it as frequently as we do some of the other classes. There's just not as great a demand for it. Now, periodically through the year, uh, companies have to uh, remit income taxes, and they will compute how much income tax they expect that they are going to be liable for that year. Again, matching. That's the income tax expense that is matched to the revenue that has been generated. Those taxes that we're assuming that we're going to have to pay are current liability, uh, because we'll have to pay them within that next year. Also, through the course of a year, companies make periodic tax payments, typically quarterly, uh, to their federal and state taxes. The differences between the actual taxable income as based on tax law and then the accounting income that we experience using GAAP, because remember, there are some differences. There are some things we can take for tax that we can't necessarily take for GAAP. How we treat depreciation is different between them. Uh, will result in a difference. We will actually really dig down in this in Chapter 19. Those of you that are taking business taxation may get a little bit of additional exposure on this. I do think there are a few of you that I believe are in Perry's class this semester that are taking that. So now we're going to roll over and we're going to talk about those, what they call employee related liabilities. This is the payroll related liabilities and taxes that result from having employees. These are amounts that are owed to employees either for salaries and wages. Recall back that at the end of a month, we accrue those wages and we match them to the time period in which they need to be. Those that are related to the compensation and not the actual wages themselves could be payroll deductions, compensated absences, and bonuses. We'll actually talk about a variety of these here as we move forward. Again, if you want a really in depth understanding of payroll and how these different things work, you may want to look at taking ACC 138 at some point in the future. Now, most of you, if not all of you, are working adults. You have received a paycheck. And on your paycheck, you might have your hourly rate or your salary, whichever you are paid. And then after that, they start taking money out for a variety of reasons. Now, there are some regular and common payroll deductions that are resulting to taxes. Insurance premiums, you could have some automatic employee savings, such as retirement, uh, and possibly union dues if you are in a union environment. So, the ones that we're really going to talk about are kind of the big ones, the ones that you're pretty much guaranteed to see anywhere. The first one of those is what we call the Social Security taxes. So, the federal old age survivor and disability insurance benefit is there for certain individuals and their families at certain points in time. This is the Social Security checks that we always hear them talking about, saying that they're not going to be there when you retire, and how are we going to take care of this, and so on and so forth. The funds that are levied for this are actually from taxes from both the employer and the employee. Now, there was a period of time following the Great Recession in which the employer's portion of the taxes was not as high as the employees when it came to the old age survivor and disability insurance tax. That is commonly referred to as FICA. However, with the expiring of that particular executive order, now it is matched. Employer and employee are both levied taxes. The current rate is 6.2%, and this is based on the employee's gross pay. So that is exactly how much you make in salary or your hours times your hourly rate. Now, here it says up to $118,500 is the annual limit. The 2018 limit is actually $128,400. This is regularly adjusted for inflation and for funding purposes. So the first $128,400 that you make will be levied 6.2% that you as the employee will pay, also 6.2% that your employer will pay. Included in the Social Security taxes is the Medicare tax or the health insurance or hospital insurance tax, depending upon how you see it read. So this was actually enacted in 1965. Congress passed the first federal health insurance program for the aged. You know this as Medicare. Now, there are a variety of levels of Medicare. You've heard of in the commercials, they're often hyping someone's supplemental this or supplemental that. This is just the base Medicare. This is not the supplemental Medicare. This is the base Medicare. It was created to alleviate the high costs of medical care for those who are over the age of 65. The hospital insurance tax that you pay, or actually that you and your employer will both pay, is at a rate of 1.5%. And this is on the total compensation. It doesn't matter if you make $500 a year or you make $500,000 a year, you will be levied 1.45% on it throughout the year. This FICA tax is the federal hospital insurance tax and is also one of the Social Security taxes that we see that is reduced or withheld from your payroll as you move through your life. Unemployment taxes are another factor. In the state of Colorado, we don't have employee unemployment taxes. However, as an employer, we are subject to the Federal Unemployment Tax Act. This is where employers will pay a rate up to 6.2% on the first $7,000 of compensation that is paid to every employee during the calendar year. So, for the first $7,000 starting in January, your employers are paying up to 6.2%. Now, if there is a state program in effect, the employer can take a tax credit up to 5.4%, depending upon what that state's credit is and what that state's uh, unemployment tax is. And then they will only pay 0.8% of the tax to the federal government. State unemployment compensation laws differ from state to state. Imagine that. And they are different from the federal laws. Employers have to refer to those various states' unemployment tax laws that are in effect in the state in which they are doing business. Now, federal and state income tax laws uh, do require employers to withhold from each employee's pay the applicable income tax that is due on those wages. So, for example, the employee is going to pay their regular income tax withholding. This is what you fill out your W 4 for, where you say you're single or married and how many exemptions you take. There's also going to be any FICA taxes potentially withheld from your payroll, and those are going to be your employee related liabilities. You take that money as an employer from the employees, and you're the custodian for it until you file the return and remit it to the proper government authority. Now, there are some actual states that have employee related unemployment taxes that are also assessed against the employee. Colorado is just not one of them. However, you will go out into the big wide world and you may encounter those in a state. So I want you to be aware that there are some states where this does occur. And then the employer related sale, the employee related liabilities are the employer's share of the FICA taxes. That's the Social Security and the Medicare. That's their matching amounts. This is the federal unemployment and the state unemployment. This is accrued as wages are earned and paid. So it is necessary for you to have those liabilities on your books until you actually remit those amounts to the appropriate authorities. So we'll go ahead and walk through a quick example here. We don't dig very deep down in this. We just kind of give you this brief 5,000-foot overview. If you are interested in this, please feel free to watch for the payroll and sales tax class to be offered. We sometimes offer it online. We're currently offering it IVS. Uh, I don't know when it is scheduled to be offered again. Just keep your eye out for it. It's really useful information for you to have. So let's look at a weekly payroll of $10,000. This is the sum total of the payroll. We're not looking at it on an individual employee basis here. And the entirety of it is subject to the full FICA and Medicare tax, which is 7.65%. Recall 6.2% of that is for the old age and survivors disability income, and then 1.45% of that is for the hospital insurance tax. There is a federal withholding of 0.8%. And oh, actually, it says federal and state unemployment taxes. So that is 0.8% of federal unemployment tax. So that's our FUTA. The state percent is 4%. And then with income tax withholding of $1,320, this was what was withheld based on our variety of employees' W 4s. And then an additional union dues of $88 that were deducted out of the employees' paychecks. So to record our salaries and wages paid and our various employee payroll deductions. First, we have our salaries and wages expense. That is the full $10,000. If there was no taxes that was being withheld, we'd have written out checks worth $10,000 to our employees. But they had 1,320 of it that was withheld. That we are going to remit for our employees to, say, the federal and state governments. We had another $765 that was withheld from our employees only in relation to the FICA taxes. We had $88 worth of union dues that were withheld from our employees. Therefore, we paid out only $7,827 in payroll checks to the employees. The remainder of that, the what is that? $2,173. I did that off the very top of my head, so please forgive me if I'm wrong. Is going to be remitted to a variety of organizations on behalf of our employees by the employer. It is for the employee's benefit. So, of that same $10,000, we also have some employer payroll taxes that are happening. We have a payroll tax expense of $1,245 total. This represents $765. That is our employer equivalent of FICA, the same amount that was actually also going to be contributed by our employees. We have the 0.8% of FUTA and the 4% of SUTA. So that is $80 for FUTA taxes and $400 for SUTA taxes. These are marked to payable until we remit them to the appropriate governing jurisdictions. Another area as an employer that we need to look at is compensated absences. Some of you are working in areas and fields where you get vacation time, PTO time. Compensated absences also includes sick time, holidays. You may have paid maternity, just really depends upon the case. Now, we will accrue a liability in the event that all of these particular conditions exist. So I want you to think back to the definition of the liability as we talk through this. The definition of a liability, we covered that in the first chapter, or in the beginning of the chapter, my apologies. First is that the employer's obligation is attributable to employees' services already rendered. Here is that past event. The obligation arises as a result of something that has happened. The obligation relates to rights that vest or accumulate. This means that the employee has a right to these funds. Uh, they are vested in them. If they quit, then they get their amount of hours paid out. It may not be at 100%, but there's some type of vesting or accumulation related to it. There is the assumption that the payment of the compensation is considered probable, and then the amount can be reasonably estimated. Now, we do actually talk about some things on this, so I want you to think about most of the time, the amount that a company is going to accrue for their compensated absences is going to be related to how much the employees make today. This is not necessarily how much is really going to be paid out in 6 months when they actually take their vacation. Because they may have gone through a COLA, cost of living adjustment, or they may have gotten a raise. However, the most easily defined and concrete amount is based off what they make today. Any differences that occur in the future, we will attribute to our salaries and wages expenses in those periods. So as you can see here, this is what a typical representation of compensated absences would look like. It'd follow right there underneath accrued salaries, wages, and commissions, along with the accrued pension liabilities, if there are any for the organization. So let's go ahead and think about this for a minute. We're going to go through this illustration, and we are going to talk about Amutron Incorporated, who employs 10 individuals, and it pays each of them $480 per week. Employees earned 20 unused vacation weeks in the year of 2017. In 2018, the employees used those vacation weeks, but now they each earn $540 per week. So the first thing we have to do is on December 31st, 2017, when our employees are earning $480 per week, we need to accrue that vacation because they have earned it, they are vested in it, it is probable, we can reasonably estimate. So that expense is $9,600 attributable to 2017. And then it's going to go into salaries and wages payable of 9,600. It can also go to accumulated compensated time off. Now in 2008, when we actually have this vacation pay paying out, probably in the month of June because everybody seems to take their vacation along the same schedule as schools, we would reduce the salaries and wages payable by the amount that we had accumulated for that purpose. We would code to our salaries and wages expense the difference in the per week amounts of $60 per week. So 60 times 20 is 1200. And that's going to be our total payout of $10,800. That is $540 times 20. Just again, another reminder, we're just hitting all of this very high level. We'll probably work through a little bit of this as we move into the actual lecture next week in class. Uh, but as far as down and dirty details, to get that type of information, you'll want to take your payroll and sales tax class, ACC 138. I don't know if it'll be offered this summer online, but just keep your eye open for it. Now, bonus agreements. These are something that are typically in place for a variety of positions, such as sales positions may have bonus agreements that are related on volume of sales. There may be a bonus agreement on metrics. There may be a bonus agreement related to income. And then these can actually get super complex. A bonus is, in essence, additional amounts of compensation that is in excess of the base salary. When they are earned, they are deemed to be operating expenses, and any bonuses that were earned in a year but were not paid out in that year should be reported as a current liability. So, for example, year-end bonuses, bonuses that were related to operations in 2017, those will be accrued as adjusting journal entries into 2017 marked as a current liability or bonuses payable, and those will be paid out in 2018. Just to kind of give you and whet your appetite a little, we do talk about bonuses more in other types of classes. Um, just know that when they are tied to a variety of operational or financial metrics, they can get very complex. So Palmer Incorporated has income for 2017 of $100,000 with a plan to pay out bonuses of $10,700 in January 2018. They make an adjusting entry on December 31st to record the bonuses as a part of their salaries and wages expenses of $10,700. They may actually even have their own expense called bonuses expense. And then they recognize that to their salaries and wages payable. Uh, and there we go. When they go to pay this out, salaries and wages payable will decrease by 10,700 and cash will decrease by 10,700. Oh, we talked about long-term debt last semester, or for those of you that weren't with us here in the IVS rooms last semester, you talked about it in ACC 211. So, with your long term debt, this can be any type of long term debt. This could be bonds that are coming up for maturity. This could be your mortgages. This could be your regular payments on equipment. It's just going to depend upon what the nature of your long term debt is. The portion of those that are due within the next fiscal year are considered current. I will actually bring to class for you an amortization schedule, and we will work through that and show you how that works. Um, I will also be looking for financial statements to bring to class to you to kind of show you how, when you can exclude it, how it is done. Hopefully, I'm successful in finding an organization that does practice in that way. So, those that can be excluded are those long term debts that are maturing currently, if they are to be retired by assets that were accumulated that have not been shown as current assets. So if you acquired some assets uh, over a period of time and their sole purpose was to fund the retirement of the debt, that could be your investments, that could be long term investments that you engaged in. Then you can exclude them from the current and have them in the long term. They can also be excluded if they have been refinanced or retired from proceeds of a new debt issue. One of the things that we have talked about and that you'll hear about in finance class and in other classes is that a lot of times bond issues are retired by another bond issue. So as one comes due, they offer another one. So if that is retired by another bond issue, it does not have to be recognized as current, or if they convert it into capital stock. So sometimes your bonds or some of your notes may convert. In that event, then obviously they're not going to be a current maturity. If they're going to convert into capital stock, that is an equity offering. Now, that takes us through a variety of different types of current liabilities. As I said, this is the quick and dirty. This is the review information. I have pointed out some specific areas we'll dig down in when we come into the classroom. And be prepared with questions and send those to me ahead of time so that way we can use our time wisely on Monday. Thank you.